Today, Moss will share his insights on the key trends that are shaping the global market in 2025, covering several topics, the resilience of the global economy, the growing influence of BRICS, shifts in policy focus from inflation to employment, impact of several trends, for example, AI, and also nuclear energy, corporate earning growth, and market concentration risks. So we have a rich session today. Please join me in welcoming Moss. And please, Moss, go ahead.
Thank you, Essa, for that fabulous introduction. It's a real pleasure, honor to be presenting to you today and the WEF Forum. So really, really happy to be here. I will probably talk about 25 minutes or 30 minutes or so, and I want to leave hopefully as much questions as possible. I have an encyclopedia of knowledge here at EFG, and I certainly will try my best to answer as many questions or burning questions in this very, very interesting market and macro and geopolitical moment that we have today, obviously, with Mr. Trump in the White House. I was going to say the warehouse, but maybe it should be the White House. So let me kick off. First of all, just an introduction. Obviously, Esther gave a nice introduction. I've actually been with EFG for 30 years and really started EFG, actually started pretty much at that time. And in my team at the time, it was me and my boss. We started with $10 million of our client money. And today, after 30 years, EFG has $165 billion of assets under management with 3,000 employees. In my group, we run roughly $70 billion and 200 people with investment professionals all the way from the West Coast, Silicon Valley, into Miami, Latin America, London, where I sit and many people, my colleagues sit, Switzerland, and then in the Far East in Hong Kong, Singapore, and even Australia. So truly global institution. And my job is to be a sponge, soak all that information from all of those sources, all those people on the ground, and hopefully bring to you some very interesting insights. So it's going to be an interesting session, I hope. And as I said, I'll talk about 25 minutes, and then we'll leave plenty of time for questions. So I'm going to share my screen, so hopefully you can see that absolutely fine. So this is our 2025 outlook, and if you're interested in the outlook in more detail, you can actually go to the EFG International website, and you're able to download the information. There's a QR code and various other things, resources that are available to you if you indeed want to dig into that topic in a little bit more detail, or you wanted to understand a little bit more the background and the data that I'm presenting. So this is our 25 outlook, and I really start in the true honesty, integrity of transparency. And actually, these are 10 predictions I made and the team made exactly 1 year ago. So we actually track our predictions. And then, in fact, if you're interested, we have our predictions going back all the way 10 years. So, or actually 15 years. And you can track one by one. And our record's pretty good. And I guess this is why you are on this call. So hopefully get some more predictions these right. So around 7 or 8 out of 10 is usually our scorecard. In fact, 1 year I did have 10 out of 10, but I marked it down because I didn't think anybody would believe it. Two ones I'd highlight that we got wrong in 2024. First of all, was undervalued currencies recover. In fact, we felt the dollar was overvalued, and we were right all the way up until the end of September. And then Donald Trump came along and spoiled the currency party, and the dollar strengthened quite substantially. So that was incorrect. And then we had favor small cap stocks against large companies, and that worked. And our measurement period is to the end of November. So we're up about 18%. So we weren't wrong that much. but large caps outperformed small caps, and so as a result, we were incorrect. Maybe 7.5 out of 10 would have been a more fairer scorecard for last year. By the way, this is not marked by me or my team. It's actually we get someone outside of EFG to mark the scorecard as well. So as I said, we try to be quite transparent. And the reason why I do this is I always say to anybody who's a decent investor to write your thoughts at the beginning of the year because you don't know where you're going if you don't know where you started from. So write down beginning of the year 10 things that you thought the world would happen and look at the end of the year and say, okay, well, and during the year actually, was I right? Was I wrong? And hopefully if our nice colleagues at WEF invite me back in June, we can see what the half-year scorecard is relative to the full year. That's, again, something that, we do. Okay, so let's do a quick market review. And this table is a little bit busy, but I wanted to just kind of outline what I see the 4 surprises for most investors in 2024. The first surprise, that growth equities or technology stocks did as well as they did. In fact, they're up 35% for the year. S&P 500 was up 23.3. Now, interestingly, the average US equity strategist was minus 2% for the year at the beginning of the year. And so they were wrong by about 25%. So it just shows you how difficult this environment has been and actually why so many people have got it wrong in 2024. That's the first surprise. Second surprise, look how well China actually did in performance terms in 2024. In fact, China was up somewhere between 18% for the Hang Seng and the H-share up 26%. It was a phenomenal year. In fact, beating the S&P, but no one talks about it. And this time last year, China started with a minus 10% return and rallied something like 35% over the course of the year. So I'll talk about that a bit later on. But again, that's a real surprise. I don't think anybody really expected that, given that China has been in the doldrums and for many people uninvestable. The other then on the right-hand side is on the fixed income markets. These are the corporate bond markets. And I would say high yield at a 8.2% return was a really positive surprise. And so the message for 2024 was to take risk in fixed income. You had to be risky to make a return. And I think, again, most people were surprised given how poorly fixed income markets in general did. US government bonds were only up 1.2% for 2024. And then the last one is gold. Gold was up 27%. It was a huge return for gold last year. And again, big surprise, because in an environment where you had dollar appreciation, you had low volatility, you had interest rates are relatively high, these are like the kryptonite for gold. In those environments, gold does badly, but it confounded the skeptics and was up 27%. So that, I think, was a big surprise. And I'll talk a bit later on why we think that happened and, kind of what's going on. In fact, gold has started the year at 7% already for 2025. So, I call gold the Mag 8. Magnificent 7 is the 7 tech stocks. I call gold as the 8th mag at the moment because it's performing exceptionally well. So let's go into what's on investors' minds, what I think is on your minds at the moment. So we use Google Trends analysis. So our view is that Google never lies. Whenever you want to find truth, you actually go to Google to find the truth. Or if you want to find out about a fact, you do it through Google. And then what we use data, machine learning to kind of have a look at some data science, to have a look at what are people searching for. And we split them up between macro trends, this on the left-hand side, and thematic trends on the right-hand side. On the macro trends, 2 or 3 things are really interesting. First of all, when people search for inflation, recession, nothing there. So people are not worried either about inflation or that economic growth is going to slow down. And that I contextualize as a benign economic environment. There are no big worries, big fears, the normal in the search terms for investors. Now, where we've seen these big spikes is the BRICS, or as they were previously known as Brazil, Russia, India, and China. Today, the BRICS is actually, believe it or not, 10 countries, and they represent half of world GDP. So I'll come back to that particular point in a moment, and you can see a big uptrend in search terms on BRICS. Now, if you move then on to the right-hand side, you can then see the search terms on a thematic basis. And here we put AI, and you can see the beige line is AI. So yeah, high trends. Everybody's trying to search the answers for AI. But the most important trend at the moment are the weight loss drugs, i.e. the GLP-1s. These are the drug compounds that lead to weight loss. And this is actually the number one trend at this point in time. And, ignore at your peril. So those of you who don't know what the GLP-1s are, these are, if you like, appetite suppressant drugs that basically you take and you don't feel hungry. As a result, you lose weight, and it has good benefits on cardiovascular and so on and so forth, diabetes, and you lose weight. And you can see that's the most popular. Now, the conventional wisdom is that the companies that should do well as a result of GLP-1s are the companies like Eli Lilly or Novo Nordisk that make these drugs, Ozempic and Wegovy and so on and so forth. And I'm sure some of you or all of you probably know somebody who's on a weight loss drug at this point in time. But where it gets very interesting is that people who are on weight loss drugs, surprise, surprise, drink a lot less alcohol, they eat a lot less food. And in fact, studies show that when they walk out of Walmart, they have a 10% lighter basket. And that's important because the worst performing sector over the last year are actually companies that make food and companies that make alcohol or sell alcohol. And so this is having a real impact, not on the drug companies as much as it's having on those food companies. So the worst performing companies in performance terms over the last few years are basically Diageo that makes, and even LVMH, the fantastic companies, has recently had their results. And they talked about how their, business and those high are basically performing very badly. And we hear this time and time again, that these companies are suffering as a result of these weight loss drugs. And what's frightening about this trend is that it's only the beginning. Once we have weight loss drugs in pill form and so on and so forth, these companies are going to have a pretty tough time in managing through that basically less demand factors for it. And interesting enough, the young, if you're a millennial or a Gen Zoomer, I'm not going to make any judgments about people on the call today, but they tend to drink a lot less alcohol than baby boomers or Gen Xers who basically, grew up in the world of, sex, drugs, alcohol, rock and roll. So very interesting, dichotomy, i.e. our children, certainly my children, are better behaved than the adults are. But, these generational changes are certainly having quite a big impact on that. Now, one way to show this is through valuation. So at EFG, and this is usually my most frequently requested chart, we take a very neutral impact on valuation. So when we look at valuation of companies or stocks or sectors or countries, we use 6 different valuation factors, combine them together, and then normalize them over 3, 5, and 10 years. So 36 months, 60 months, 120 months. And it gives this very beautiful, colorful chart to give you an idea of what is expensive, what is cheap in the stock markets of today. Now, for reference, I've put the 8th of December 2023, i.e. this time last year, as a reference point of where valuations were for markets at that point in time. And what you can see is that stocks were actually cheap to neutral. Today, on the top panel, Lots of red. That's expensive relative to the history. In fact, the cheapest markets are actually in the UK, Europe, and indeed China. And what we've seen so far in 2025, the best performing countries are actually UK, Europe, and China in terms of their performance. And LATAM actually is also cheap, and that's also done pretty well. And the technology stocks, you can see there are lots of dark red there, they are suffering. And in fact, the US stock market is underperforming international markets so far this year. So valuation is expensive when you're looking at the markets today. So my kind of message is be more diversified, be more across the market cap between small and medium-sized companies, and more globally diversified to buy into those cheap valuations. Now, consumer staples, you notice, is also very green, but that's for a reason, as we just discussed a little bit earlier. So let's then talk about earnings. So the snapshot I just showed you is about valuation. This chart shows you what the earnings expectations for this year are. So for 2025, and I've ringed that there, you could see that equity markets are expecting 12% earnings growth or 14.2% earnings growth for the United States. So that's pretty good. So the backdrop for earnings is actually pretty positive. And then look at IT. So IT is looking for 22% earnings growth for 2025, right? So that's why it's expensive. So if we miss on those earnings numbers, if Google or Microsoft or Nvidia or any of these great companies says, you know what, we're slowing down and earnings is not going to be 22%, then there's a lot of risk in these companies in terms of downside risks. So as long as the earnings are good, valuations are high, that's fine. It's when earnings are decelerating and valuation is high when stock markets usually correct a lot more heavily. There is another very interesting observation compared to the previous years, is that this year there are more sectors showing good positive double-digit earnings growth than they were in 2024 or 2023. So that means there's more broader participation of companies in performance compared to 2025, compared to the previous 2 years. And hence why you want to be more diversified across different sectors and across different geographies, because there's a lot less risk. And actually you have quite good earnings growth trends also coming through that as well. So that's the earnings growth picture. So now let's go into the top 10 trends, and I'll rattle through these very quickly. So the first is on economic growth. So economic growth basically is going to be pretty good. And here the title is resilient. And so we do think economic growth is going to be resilient in 2025, despite some of the noise that Trump is building through tariffs and so on and so forth. But it's going to be a better second half and 26 than it is in the first half of 2025. Why? Because interest rates are coming down. Some of that uncertainty we say to tariffs will go away. And what's very clear is most economies do not want to cut their debt. So fiscal policy will remain a positive dynamic into the second half of the year. So H2 better than H1 in terms of the economy. And it's because of those interest rates coming down. And usually there's a 9 to 12 month lag between interest rate cuts and the economy picking up. So that's the way to think about it. So resilient economy. The second is BRICS becoming much, much more important. When I put this slide together, BRICS was actually 9 economies. Now they're 10, right? And they account for now 50% of the world population and half of the world's growth in 2025. So you cannot ignore this group of countries. Now, why is this important? Trump hates the idea of BRICS because it is from a geopolitical aspect, it is a threat to the US power economy. And so if Trump, for example, becomes very aggressive on trade tariffs, you're forcing countries like Europe and the UK or Canada or Mexico, saying, you know what, America, we're kind of fed up. we're going to go and join the BRICS, and we're going to join the BTO, the BRICS Trading Organization, and actually have free trade, and our existence and our survivorship and our prosperity will become with the BRICS. That diminishes America and the US as an economic powerhouse. And so I want you to think about the BRICS as a geopolitical threat to the dominance of the US economy. Now, the BRICS also talked about having their own currency and so on and so forth. I think those are pipe dreams. But in terms of trade, this is real. And this can also have a big impact in terms of China's influence, as the US has today, on economic developments in many, many countries. So this is one to really watch out for. And it's important because it represents half of the world's GDP and, of course, half of the world population. Now, the third prediction we have is around the policy shift. At the moment, the Federal Reserve has been focused on inflation, but now their focus is going to be on employment, because inflation in general is close to the targets of around 2%, right? So inflation is coming down, continues to mean that interest rates are coming down in most countries. So I give you some numbers. We expect 3.75% Fed funds interest rate. We expect 1.75% in Europe, and we expect 0 to negative rates in Switzerland. So the general trend of rates is down, and so the focus now is on employment, particularly low-end employment. Because in the United States and many other countries, we have this big divide between rich and poor. The rich are feeling very, very rich, and the poor are suffering. They're suffering from high mortgage interest rates. We already start to see loan delinquencies going up, car loans, credit card loans. They're already starting. So if you're a low end of the US consumer, you're actually starting to find it very hard, and that's starting to impact on the employment trends. So the Fed at some point will look to address that as a challenge. Now, this is one of my favorite ones, is the government deficit problem, and the DOGE in particular. So DOGE, i.e. the Department of Government Efficiency, is an experiment. It's an experiment in private enterprise running government better than government can run government. So I'll repeat that again. Private enterprise running government better than government can run government. And this is why Elon Musk and all of the great and good of the private sector are involved in DOGE and involved with the Trump government. Because their view is, look, I know how to cut costs. Elon Musk certainly knows how to put people into space much cheaper than anyone else. I know how to cut costs. I did it at Twitter and so on and so forth. So the same tools that Elon Musk is using and other private enterprise companies are using are being applied to government. Now, we don't know if it's going to work, right? There's $2 trillion over 10 years is their target cost. So far, they've started to give voluntary redundancy to government employees. And if they're able to bring the government spending to the level of 2019, i.e. pre-COVID, then actually the US government will run a big surplus. That is what is driving this agenda. Now, it's important because we've hit the tipping point. We're 100% debt to GDP of the global economy. So countries have to address this issue. The good thing is the Americans have a plan, right? DOGE is their plan. But France, the UK, others don't have a plan. So what markets are doing and currencies are doing, punishing those who don't have a plan and giving the benefit of the doubt, like the US, to ones who have a plan. And their plan is very simple. If we can get economic growth through deregulation, and we can say have 6% nominal GDP, then we reduce the debt very fast. That is the plan. And so far, Trump has done a great job to sell that plan. Now, it's an experiment. We just don't know if this is going to work. But it's going to be fascinating watching this and making some predictions around it. But so far, so good. So let's talk about innovation and change. And here we call our prediction AI goes mainstream. And this is, as a European, it's a kind of depressing chart. It shows that US so far has spent 320 billion on AI, China around 100 billion. Europe doesn't even register, right? It's like a little bar at the end. So as far as the game to produce generative AI, the game is over. You know, America has won, and the world needs to follow. And the capex spending plan, when I put this chart together, it was 300 billion, according to Morgan Stanley, was going to be spent on AI infrastructure in 2025. That now number is 350 billion, and that's before Stargate that was announced with Trump. So the numbers are absolutely enormous. The issue, as DeepSeek recently showed us, is that with all the innovation we're seeing, are are these companies going to make a profit out of all this spending? That is a big question mark. And the market is already giving the benefit of the doubt to the ones who can show that AI is helping their customer, like a company like Meta, for example, versus other companies that can't show the tangible improvement in their services to their customers, whether they're B2B customers or B2C customers. Meta is probably the leader so far that has been able to achieve that. So the big question, am I going to get an ROI on that $350 billion of investment? And that's what, when the DeepSeek news came out, which, by the way, is great for the consumer and great for AI adoption, not so great if you just spent 350 billion and someone's going to do it at half the cost. So I think that is the critical development at the moment. The next theme is around nuclear power. And I want you to think about the huge electricity consumption trends that needed. AI search is basically 10 times more energy exhaustive than traditional search, as well as electric cars and so on and so forth that are proliferating the roads. So no doubt there's going to be intense demand for electricity. Now, the second thing is, how do you supply that? On the left-hand side, this is from the IEA, you can see that China is by far way ahead of everyone else in terms of nuclear plans in construction and proposed. Way ahead. One notable absence in this chart is actually the United States. In fact, the United States is in the ROW column. Tiny, tiny investments plan so far. So I think Trump in the next few weeks is going to announce that America can't cede control of nuclear power and cheap electricity to China and its competitors. And I think that's something that geopolitically is going to be a football that Trump and China and various other countries are going to play over the coming weeks. Okay, so let's move to the next set of predictions around equity and bond market opportunities. First of all, we're pretty positive on corporate earnings growth, as I talked about a little bit earlier. So we do expect greater than 10% earnings growth for companies that are listed today. So really, really positive. And you can see over time, very strong correlation between the index return and earnings per share growth, for those who don't believe in efficient markets. So it's, earnings growth remains very strong. But we have one major concern, and that's concentration. So if I look at the S&P 500 over the last, let's call it 60 plus years, the last time the S&P 500 was this concentrated in the top 10 was in the mid 1960s. And so we have this huge level of concentration with these top 10 companies. Now, to me, this is like a tipping point. Because if you go back to the 60s, you could see that those top 10 companies didn't dominate for very long. And in fact, they started to underperform as soon as they hit that 35%. And then they had this slow demise into the 70s and into the 80s. And at that time, in the 60s, the top 10 companies were AT&T, General Motors, GE, Honeywell, Kodak, you know, none of the, many of these companies do not exist today. So the key thing is, I think we've hit a tipping point where the concentration levels are so big that the sheer weight of performance is now difficult to achieve. And that means for my business, that's great because it means that the first time in a few years, we just think being active and being in the lower mid-size or market cap or diversified is actually going to give you much better returns. And as we just discussed about the AI trade, there's risks in those investments as well, given the concentration and spending they're doing on artificial intelligence. The second to last prediction is around consumer discretionary as a sector. So the methodology I showed you in terms of our valuation, we're using the left-hand chart, goes back all the way for 25 years. And you'll see that when the consumer discretionary sector gets cheap and starts to turn up, that is a time to jump on the sector. So we think the consumer discretionary sector is going to outperform in 2025. By the way, we choose a sector that is out of favor, right? So it's got to be a contrarian sector. If I said to you, oh, I think technology is going to do very well, you probably snooze and tell me to go away, right? So we always try to pick a sector that is out of favor, and it is most managers, fund managers around the world are underweight the consumer discretionary sector. But there's another point. On the right-hand side, we have a table showing the change in the household net worth in 2024. Americans feel $15 trillion more wealthier than they did in 2023 because of higher stock markets, cryptocurrency prices, housing prices, and so on and so forth. And so we then simulated where if they spend 3, 5, and 7% of that, that has a big impact on personal consumption and income in 2025. So very powerful forces. And so a lot of Americans, and I'm conscious that many of you Americans, you'll be traveling abroad, you'll be spending that money on business class travel rather than going economy class travel and staying in nice hotels and so on and so forth. It's going to be spent. And one thing that I learned 30, 35 years ago when I joined this industry is never underestimate the Americans' propensity to consume. So we think that money will be spent, but probably be spent on the mid-level to luxury items, not on the low end of the consumer that's still suffering from high mortgage rates, high rent cost, and inflation. So very much middle to upper end. And I noted with interest that Ferrari had their results yesterday, record profits, and most of the sales came from the United States. So leisure travel, all of those things we think are going to be key themes to invest in 2025. Now, the last trend theme, and then we'll go to the Q&A, is around yield curve steepening. So at the moment, the yield curve is steepening up. You can see that little bit of a trickle up, and that is a difference between the 10-year interest rate and the 3-month interest rate. Now, we think that it goes to, say, 1% or 150 basis points. This chart where it goes all the way back to 1960. That suggests the 10-year yield on the US Treasury forecast is 5.25 if our bottom of our forecast is 3.75. So if we go back to a normal yield curve, say 100 basis points to 150, add that to 3.75, and you get 5.25. So our target for 10-year US Treasuries will be 5.25. And when it's gone to, say, 300 basis points, that's usually reserved for very recessionary periods. So that's why we think 100 basis points, 125 basis points, 150 is not a bad target for some point in 2020 and 2025. So with that, I will stop sharing my screen there and open it up to questions. So mute there, Esther, I think.
Sorry, I was muted. Yeah, do not hesitate to share your questions either directly, or you can write them on the chat and I can read them out loud, whatever you want. I think it was super interesting what we just saw. So much to take in, and probably some people getting nervous about what do I need to do with all of this information now. Um, okay, here's a question from Gerardo. What is your 2025 outlook on crypto assets?
Okay, so a bit of a private joke here. Um, I would say it's a question I get pretty much asked every single presentation. I've done this presentation at least 35 to 40 times already in January this year. Every time I've had that presentation, I've asked the same question. So unfortunately, EFG does not give any predictions on crypto prices. We can blame regulators and others for that. But let me try and answer that question in a thoughtful way without giving away too much. So for me, deregulation is super important. It's part of the reason why banks like us, can't talk too much about crypto, because our regulator is very unclear about what we can and can't do, right? And when you have opaqueness and obscurity, banks tend to be more conservative than aggressive, right? So that I think the fact there's been lack of leadership at the SEC or by any government about what you can and can't do with respect to crypto has meant that many bigger multinational companies in particular are saying, look, it's not worth our risk to opine on that. So we think Trump's forcefulness and obviously replacing Gensler at the SEC is going to create an environment where we'll get some transparency of the do's and don'ts from a regulator's perspective. That is very positive for crypto investments. And I be very careful with the word I use. Now, unfortunately, for crypto assets and asset prices, it's not that straightforward. Because when you have complete transparency, you get a lot of efficiency coming into the market. Think of FX. Nobody that I know consistently make monies out of foreign exchange trading. So when I think that we get a huge amount of transparency and everyone can trade hundreds of billions of dollars every day, or trillions of dollars in crypto assets every day, the efficiency goes away, or becomes more efficient, sorry, and the inefficiency goes away. No one controls the market. And then you start having, actually less returns for clients out of crypto investing. And then the company that always makes the money is the bank that's facilitating the transaction. So my view always is, always buy the house, not necessarily trade the house, right? So that's kind of my view around cryptocurrencies. Now, as we go through that journey of transparency, then of course crypto prices will remain fairly robust. So if I can answer that question, we're in the journey of transparency, inefficiency goes away, and we get very efficient markets, and then the bank will always make the money. And you can see that already with BlackRock, who launched the Bitcoin ETF in 2024, the most successful launch of an ETF ever, and probably the most successful that ever will exist as well. And I can assure you that BlackRock have made more money out of it than many other people. Sorry, Esther, slightly long answer to that question, but hopefully...
No worries. We have more questions. So David Coronado is asking, what do you think is going to be the Trump effect in Mexico, specifically in industrial activity terms, with all the new...
Yeah, absolutely. Well, the game already started, as we know, the weekend. So look, it's hard to know because we just don't know what the ultimate motives of Trump are. Now, if it's around immigration and fentanyl and all of these sort of activities, and he's happy with that, if Mexico can deliver that, then I don't think there'll be much impact on the industrial policy because the tariffs will stay as they are, or there may be minor tariffs that make it difficult. Now, this is the issue, is that clearly adding a tariff on Mexican goods is bad for the US consumer. Nobody wins in this environment. Everybody loses in this environment. And Trump and his very savvy economic and business professors know that sitting in and around him. So then we've got to try and figure out what the motivation is. And I think that the motivation is still non-financial motivation rather than the financial motivation. So I think there will be some tariffs. So then it's about expectations versus actual. I believe when I look at the consensus out there, most people think, 10% on tariffs on Mexico is probably where we land. 25% is on the high side, 10% is where we land. If we land at 10%, most people will live with it. And that's kind of how I think about it. So still not great for either the Mexican economy or the American consumer and the American economy. But people will live with it. And remember, with these tariffs, it's usually a one hit. So once on inflation. So once it's done, next year, as long as it's not repeated, the effect washes away. And so I think a 10% is probably likely. And I think Mexican industry will be fine with that 10% because consensus is already there. And by the way, the Mexican peso has devalued already against the dollar, already negating the impact for Mexican companies.
Thank you. We have a couple of questions from Gustavo and Irene and Catalina about the real estate outlook. We've seen very heated markets in recent years. So they're asking in general, but also specifically for the US and LATAM.
Okay. So LATAM, I know less of in terms of real estate, but certainly on the US real estate side, I'm actually pretty positive, actually, because if economic growth and interest rates are obviously coming down, I think certainly on commercial, I would probably have a more. You have to be quite picky in terms of commercial real estate. I'm actually a lot more optimistic on, because bank deregulation, the low interest rates, low credit spreads on corporate debt, going back to work trends, all of those are now, I would say, tailwinds for the real estate sector rather than headwinds. But again, it is quite nuanced. For example, if you're doing low-end housing, it's tough out there, right? So low-end housing is bad. High-end condos in Miami or wherever it may be are still very much supported because the wealth effect, as we just discussed, is very strong. I think the Fed will still continue to cut interest rates, and mortgage spreads probably come in a bit, maybe 100, 150, but that's about it. But overall, actually constructive on real estate. In fact, it's one of our overweights within our sector allocations in the United States.
Good. Someone was asking I can't remember what the number 7 trend was, but they were asking if you could elaborate just a little, briefly on that.
Yeah. So let me get the seventh trend on there so that we're all on the same page. So on corporate earnings growth, hopefully this is the one. So essentially what we're saying, in fact, I could probably just flip back here. So earnings growth, look at this left-hand side where it says US 3.91, 9.1, 14.2. So earnings growth trends are actually pretty solid. And for stock markets, what they like to see is you go from low to high, right? The journey is much more important than reaching the peak. And those earnings trends are very positive. And that provides a very strong backdrop to the global equity markets because we have these positive earnings growth trends. Now, on top of that, you can see here the gap between, say, IT, which is the fast, this is 22.8. We've got healthcare at 18, comm services at 13, materials at 16%. There are many more sectors that are showing these double-digit earnings growth trends. So earnings growth in general is looking to accelerate as we move forward, and they also help if US interest rates continue to come down. So I think that's also a very important development. So when it comes to this trend on seven, is we think earnings growth will provide support for the stock markets, and then we remain in this sort of buy the dip mode. So whenever the market dips 5 to 10%, investors are buying because the earnings trends remain pretty positive.
Uh, Good. Okay, another question. Have you studied Ripple XRP as a digital asset that has the technology to change cross-border payments versus the SWIFT system?
Yeah, so we did some work on this quite a few years ago, obviously when blockchain and technologies came through. Look, it's very, very interesting. It's an exciting area. Many companies that are, trying to get involved and trying to think about how these technologies can help. Um, to be honest, I haven't looked at who could be the winner and who's the loser across that. We're already seeing Ethereum, for example, the Ethereum platform or Ether platform has been challenged. We can see that at the moment, so being less of a use case. But Solana, as we saw with the Trump meme coin and the Melania meme coin, you know what? That's uh, that's one that's benefiting. So I think, look, it's really hard to make predictions of who's the winner here. Um, and but I think for me personally, you know, Solana platform and not necessarily Solana itself, um, for me seems to be one of the kind of winners out of this, and you can see that in recent trends within those prices. So again, no, I'm not an expert. I would be last one to say that I was an expert on this. I'm just being observational in terms of some of these trends.
Okay, another one here. Why do you think Buffett's Berkshire, I guess, has sold so much stock and is sitting in approximately 300 billion in cash? Some say, sorry, I lost it. Some say they are preparing for a crash. Others say they are preparing to invest on something else. What is your view on this?
Um, wow. Okay. So obviously, he's been a big seller of Apple stock, right? So, he has been doing that fairly consistently, as well as, Wells Fargo, Bank of America, and so on and so forth. So, he's certainly accumulating a lot of cash. Look, I think as I showed in valuations, Warren Buffett is a very deep value investor. And so he's basically waiting for a better entry point to be able to find those opportunities. He typically, he's usually zigging when everyone is zagging, right? So I think that is his comfort zone. But I think there's a question mark. His age clearly has had a big impact. The fact that Charlie Munger, his cohort for many years, has passed away. And I just wonder whether, he's handing the reins over to the others. And as part of that, let me clean up shop, before I hand over, because it goes to the next generation. So, these things, these are, ultimately human beings, right? And they have amassed a huge amount of wealth. And they're in their 90s, or he's in his 90s. So, you know, so I can't help thinking that the risk appetite is no longer there, because if his time horizon is typically 10 to 15 years, there's a very high probability that one of the greatest sages of investments will no longer be with us. And you can't help thinking that that is part of the psychology in this environment. And as you know, people do at that age, they're usually starting to hand over the reins to others. And the best way to do that is to give them a very clean, cash pile to make their own decisions and take a new turn. So I think, I'm kind of part psychologist, part investor thinking about this.
Super. Someone was asking if there's any other thought you could share on the impact in Latin America as a whole, not only Mexico, because of the US political changes.
Yeah. So I think, there are two very, very obvious trends. First of all, if I take Argentina, Milei is a best friend of Trump, right? And not just Trump himself. He's also philosophically very aligned to some of the tech bro billionaires that are surrounding Donald Trump. So, so the psychology, if you like, and the political psychology is very much aligned along those developments. So I think Argentina will be looked at as very favorably by the Trump administration, pretty much for whatever they need. So I think they would certainly be very much in favor of Argentina. On Brazil, I think, to be honest, Brazilian economy, I mean, the central bank is doing a great job, by the way. I think raising interest rates, curbing inflation is exactly the right thing that we would expect a good central bank to do. And so I'm actually quite constructive on the macro principles of Brazil. But we kind of need a change of government. And I think that the change of government won't really happen until the second half of 2026. So for me, I like what's happening in the short term. I like they're raising rates and they will curb inflation. And then if we can get, I guess, a more business-friendly political regime, which I expect to change in 2026, right? They went in the 2026 election. And I think that the run up to that may be a little bit more positive. So on kind of Brazil, I think it remains very much a tactical market for this year. And then a much more interesting market as we go into 2026, particularly if it becomes clear that there's going to be a change in the Lula government. And we already have a central bank that has cleaned up shop from a macroeconomic perspective by then. So I'm actually, last year, Brazil was a horrible place to invest. I think this year is going to be much more of a trading, market, but then it gets much more interesting in 2026.
Super. Maybe time for one last question before we wrap up. You talked quite a bit about the BRICS and how, and it's getting bigger, and it's also challenging a bit, the I don't know, the balance that there was until now. Do you see, what do you think is the impact of this going forward? Like, do you see a reshuffle of
Yeah, yeah.
power?
It's super, super interesting, right? Because um, there's a book if you get a chance to read it, and I'll encourage the people on the call to read a book called The Prisoners of Geography by Tim Marshall. We actually had him at our conference last year, and he gives a very, very interesting view on the US policy since Bretton Woods and the NATO, and basically what happens if Trump leaves, brings the United States out of that. Very well worth reading, and I certainly encourage you to read that book if you haven't read it already. It is one of the most popular, geopolitical macro books, at the moment. So I would, Tim Marshall, Prisoner of Geography. So he basically his framework is the U.S. The reason why we have stability in the world is the U.S. is involved everywhere. It's involved in Asia, Middle East, Europe, and so on and so forth. And that has actually led to a relatively stable world economic order. Now, China's come in and has upset the apple cart a bit, right? But not significantly. It's debatable whether China really wants to play that new global lead. But Trump policy is basically taking the US out of that global world order that existed since the Second World War. Because he's saying, well, NATO, you got to look after yourself. I don't want to have these forever wars. Why are we paying for this? Everyone should pay their fair share. He's a very myopic view on trade tariffs, but forgets all the huge benefits the United States has had as a result of that deal. Now, if Trump pulls America out of it, it creates a vacuum. And there's two things can happen. It can collapse world order, and every country does its own thing, and we get this kind of geopolitical world order that comes along. And that's a horrible situation to be in, right? Because it means that we go into every continent for itself, and not a great global economy. So that is the backdrop, right? And this is what Tim Marshall actually talks about. So if Trump is to do that, from my perspective, what we need to do is have a counter, which is the BRICS, which says to the United States, look, we're here. Hey, we're here, right? If you really pull out of this world order, we will plug the gap to a certain extent. And then countries like Europe or the UK, we're in the middle. We're stuck between a rock and a hard place. We've got to make a decision then. Do we stay with our American cousins, right, and the UK special relationship? Or do we go to the BRICS where basically they buy our exports? And so that sort of strategic tension. So to me, the BRICS is a positive development because it gives everyone an alternative, but B, the Americans can't be as aggressive to the ultimate pullout of this global world order because they know there's an alternative that could actually diminish the American superpower. So that's the framework that I think the BRICS towards. Is, again, very interesting, very fascinating. We don't know the answers. I wish I did, but it certainly will provide a lot of intelligent thinking and discussion for many years. I am sure.
Almost. I think it was a great presentation. Thank you so much
Not
for
at
your
all.
perspectives on all of these trends, and thank you everyone for attending. See you next time.
Thank you, everybody.
Thank you.